Welcome everybody. Welcome to this 4-part webinar series. Today is the last part. Hope you guys have enjoyed this series brought to you by belltpo.com. Myself, Dean, as you all know. Today's topic for the presentation is integration, combining traditional technical analysis, MP, and order flow for better results. We have been studying these 3 parts separately. Now today we'll try to combine them. Also, along with this presentation, the 4th part, you have some more benefits coming your way. We have 3 speakers today, including myself. After my presentation is done, those who are using BellTPO softwares or want to purchase them, Mr. Vinod from BellTPO will be taking a session on how to set up BellTPO softwares, both Bell Market Profile and Bell Order Flow on NinjaTrader 7. Post that, we have everyone has heard about True Data. Most of us are using it. I for sure use it, their services. So Mr. Kapil from True Data will be taking a session. He will be the 3rd speaker for the day, and he will be taking a session on how to set up True Data on NinjaTrader 7 and how the data can flow into BellTPO softwares. So we have quite a few things to cover today. So let me just not waste any time and start with the presentation. So as usual, let me go through the disclaimer first. Information shared here is not a trading recommendation, and we are not in a business of providing any. All information shared here is strictly for educational purposes only. Please use your discretion while acting on the information shared here. We will not be responsible for any resulting profits or losses. Please consult your registered financial advisor before you make any trading and investment decision. A small note, again, as I do it every time, in case of any technical problems, the webinar will be rescheduled at a later date and you will be informed about it. Please post your questions in the chat window. I would cover them at the end of the presentation if time permits. Else they'll be covered in a separate Q&A session for the Slack group members. Those who still are not a part of the Slack group will get a link at the end of this presentation on how to join it. This webinar is being recorded and will be available for a limited period of time on the Slack group as well as the belltpo.com website. Those who missed the last webinars and are coming here for the first time will also get access to them on the belltpo.com. Okay, so let's dive into the presentation. Before we move ahead, let me just review what we covered in parts 1, 2, and 3 in brief. So at the beginning, we set out to review different traditional technical analysis techniques and tools and their pros and cons. We covered quite a few of them: trend lines, indicators, patterns, all those moving averages. We covered all those things, and we saw what were some of the common problems associated with those tools and how they can be avoided to get better results. And for that, we got introduced to market profile and order flow analysis. Now, once we got that introduction, then we tried to set a stage to build a deeper understanding of market profile and order flow concepts with one individual presentation on each topic. The 2nd and the 3rd part covered these topics in detail. We also covered some essential basics for market profile and order flow analysis. And then we, did the most important thing in the presentation. We covered some examples where we tried to assess the risk of a position, whether long or short. And we did not try to, point out levels where the market will turn or setups or patterns which we, try to find in the market to take profitable trades. No. What we did was, we lay out a basic foundation, and that was to assess the risk, whether current market is conducive to holding long positions or not, whether the short positions which we have should be covered here or not. We tried to assess the risk of the positions, and then used order flow analysis to identify where the buyers or sellers might be accumulating their position or distributing in the markets. We also use profile shapes for that. And what we did was we tried to confirm, whatever analysis we arrived using traditional technical analysis or market profile with the help of order flow. So we tried, slowly we went on introducing one additional tool, like with traditional technical analysis we first saw, then we studied market profile, then we studied order flow, and we also looked at some setups like delta divergence and trap buyers and sellers to get an idea where we might be entering the positions, where there might be a good time and place to enter positions using order flow. So we have been studying these fantastic tools individually. Today what we are going to do is to try to bring it all together. Now this, it may happen, you might feel that this presentation at some points might be a repetition of what we have done already. I mean, the concepts, I have tried to take separate examples, but the concepts you might feel that they're getting repeated. But what I want to share in this particular presentation is how to bring all these things together, so that disadvantages of one method is countered by the advantages provided by the another, and at the end of the day you take up you end up taking best of from all three methods and try to improve your trading, improve your results. Okay, so that was the review of parts 1, 2 and 3. In case anybody has missed it, they can get the recordings on Bell TPO website. So that was first 3 parts. So what we are going to do today. So today's objectives are to understand the importance of integration. Why we need to combine these different technical analysis tools. See what different tools contribute to trading. Now I have written here traditional technical analysis, market profile and OFA, but since I use only market profile and very little traditional technical analysis, I will leave that part to those who are already using traditional technical analysis, and I would encourage them to be a part of our Slack group and post their queries there, and see how market profile can help them in using their traditional technical analysis methods. So we'll combine market profile and OFA, and we'll see some examples how to get a better grip on the markets and to enter at the right time and place for your trades. Then a very brief introduction to micro profiles. Now this is a very great customization that Bell TPO softwares provide you. You can plot profiles for any duration you want. I use these 30-minute profiles with 3-minute individual bars, similar to a day profile. I'll clear that up when we get to the slide. But I use it to find great setups for intraday trades. I have covered yesterday's trading action, so not in very detail because it's a big topic and we need much time and to understand that. We'll maybe take another series like this, but I have introduced it at the end of the presentation. So what is the importance of integration? Why do we need to integrate these different tools to why integration is required? I'll like to quote Robert Kiyosaki. I hope everybody has heard about him. He says that a team will always trump an individual. What he has written many good books, and what he always states is that if you try to take on the world by yourself, you're most likely to lose. Because professionals, they don't work alone. They have their advisors, they have people who do things for them, and they plan in advance on how to use talents from different people to achieve the objective of the company or their business. Now in trading, how I look at it is you need help from many people. Like first and foremost, you need your broker to help you put trades in the market. That is the first thing. Second, you might require a great technical analysis software, the kind provided by Bell TPO, which I use. But then that software needs reliable data that comes from true data, which I use again. So I'm just stating what I use. And and then you have to come into picture and use your skills and analysis to trade market successfully. So here also you can see that the four different individuals or teams or people are coming in to get that result of placing trades. And how we place those trades, where we place those trades, again we need a team, and that team is nothing but this technical analysis tools which we combine to get a broader perspective of the markets. You look at MP, you get one thing. You look at order flow, you get one thing. And as I've already stated many times, that unless and until you have that proper context with you, these individual tools will definitely mislead you, misguide you into the market, and the smart money will always exploit the patterns which are working in the market, and in turn making them ineffective. So you always have to be on your toes. You have to use you have to combine many technical tools to get a broader picture, to a truer picture of the market, and then get into placing trades. So that's what I said. It will help you put in filters to avoid unreliable inputs from different TA tools. Now I use market profile. That does not mean that at every time market profile is correct, because market profile at the end of the day is not an indicator. It's just a way of organizing data. It's just a way of plotting price and volume data on a chart. So it is a tool. Order flow is a tool. It just shows you where the buyers and sellers are. It does not tell you where the market is going to go. What we have to do is to combine these tools and then try to find repeatable patterns of behavior of traders to help us gauge whether a particular time and price is correct for entering the trade or not. So that is why integration is so important. And I covered all the topics individually, and I could have stopped at that, but now that is only half of the job done. In today's brief presentation, we'll cover 50% of what we set out to do, where we integrate all these tools to try and trade. So I wanted to share how I look at the markets, and how I arrive at my decisions. Okay, suppose I come into the market and I hope to trade, I hope to take some profitable positions. What is the process I follow? Because I am a big believer in process. Levels, signals, setups, all these are not important unless they are part of a good laid out plan or process beforehand, before getting into the market. So what do? I do these. This is a very this is not in detail at all, because I cannot share everything here in this limited time. But I have tried to give you a gist of it. And what I do is I study previous day's action in detail. Now I try to study previous day's action in detail to get some context. Now the context might be who was the stronger party for the day, whether the buyers were strong or sellers were strong, or maybe what are the important references that are standing out from yesterday's action. Now yesterday does not mean that it strictly yesterday's profile. It means that the recent action which is going on, maybe for sometimes last 2-3 days are relevant, sometimes just yesterday we will do. So I try to gauge what has happened recently in the market and how that might affect the future market action. And the best way to start is to start with the latest day's profile. And if you feel that the information coming from that profile is not sufficient, then you start going one days back, further back into the past, and trying to get that elusive context which everybody is looking for. Once that context is ready with me, once I have understood what was happening, what may happen given these conditions, I then focus my attention on the open, where the prices are opening. Now open types are being discussed on social media and everywhere, and in Dalton's books they have been described in detail. So it is a very important part of forming a view for the day. I mean, just because a price opens somewhere, in relation to what has happened in recent past, you can get a fair idea of what market might do for that particular day, or whatever your analysis was from the previous day, whether the open supports that analysis or not, or the traders have at the start of the day only they have thrown your analysis in the bin. Something like that has happened, or maybe the open confirms your analysis and then you feel more confident of trading that particular day. So that is a very important part of analysis. Then I monitor the early rotations. If you have been in Slack for some time now, I don't post till first 2-3 periods are done. My morning views of the market, I like to see how the initial action is happening, where the traders are taking the price and what response they are getting, before I make a assessment of the potential market development for that day. So then what I do is I look for potential trades. That is, of course, within the context which I have been gathering and confirming using open and early rotations, whether the context I have gathered is correct or is there a change or something of that sort. Then I use micro profiles to gauge what is the auction bias intraday, small rotations which happen during the day, and then use order flow for timing the entries. Now, most of my trading is intraday. I like to scalp for 5-10 points. I'm not a swing trader who is trying to capture 100-200 points. But if that comes along, then I welcome it. I use position sizing and put my trades in such quantities that they don't affect how I sleep in the night. So this is a small what you can say glimpse of the decision making process I use. There are many factors, of course. I mean, this is not uh, exhaustive at all, but I just wanted to give you an idea that what I do and how I reach to my trading decisions. So let's move on. So let's straight away jump into examples. Today, since we don't have to cover many basics, and this we have already covered in previous presentations, today's presentation might not be very long, but definitely it's the most informative. That's what I believe. So I am selecting the 30th Jan on Nifty futures, and we'll monitor the activity for 2-3 days going from 30th to see how these things behave. So, okay, 27th, we have this profile. Then we had that weekend. And on 30th, yeah, let's just, briefly analyze what was happening on 27th. So 27th, you can see that this familiar, P shape. As you can see, it was a nice P shape. There was a big gap up opening in the morning, and prices just rallied sharply. But then, as you can see, they did not continue to move higher. They did not continue to move higher. We had this, nice balance. And after a gap up opening, prices not coming back to the open and testing the low, and still not able to gather that momentum to go higher, it immediately warns you that something is not correct. And in this case, the buyers were controlling the auction, but now sellers have stepped in. As a matter of experiment, what you can do is on your profile, if you remove this A period, you will see a nice balance. And as I have already stated, that a balance means that both buyer and seller are in balance. They are matching each other in strength, and that's why the market is not going anywhere but just moving sideways. So this did not happen, and that immediately alerted us to a possibility of market testing the lower references, because market not finding buyers in this region to push the prices up. They will have to find buyers, and buyers would always like to buy cheap. I mean, who does not like to buy cheaper than what the price is quoted for any product or any service? So we always want to buy cheap, and if we are not finding buyers at this price, it means that 8680 is a high price, we have to explore lower and find buyers at lower prices. So that was the expectation. And what happened? We opened down very close to the low, very close to the low. I had marked this particular orange box in my Slack analysis and said that if I find anything in this region, I would like to buy. If I find anything in this region, I'd like to sell. But see how your views should change, because as soon as the market opened lower, it means that we have rejected this balance for the time being. Now, once that has happened, immediately all these hypos which I had drawn earlier or in the morning, they change a bit. You have to adjust your expectations immediately. As we see it opening here, and if we get resisted while entering the value, these two hypos won't do, they won't help. Immediately this hypo gets precedence. So what happened? We tested below the low, we found nothing. Now this immediately opens up the opposite end of the range, but then we have to see whether we are finding acceptance inside this value area to move higher. So if we get that, then only we'll see higher prices, else we'll see lower prices. So what happened? Yeah, what we did, we just balanced lower. Yesterday's low, we had an FA. What FA demanded was immediate continuation to upside. If this was an FA, sellers have found nothing at the lows, that means sellers are not interested in lower prices, and that immediately should have pushed this auction higher. But what happened? Prices just consolidated here. Now, where were we consolidating is another important factor. Where were we consolidating? We were consolidating in the single prints of this P formation. So if buyers were strong and they did not want to trade in this region, they wanted to take prices higher, the next day prices accepting in this region of rejection is a sign that whatever strength these buyers had, it's not there anymore. Now, once these buyers are not, defending, immediately our, attention should shift to a lower reference, and the lower reference is the spike top. Now, we might reach there today itself, or on this day itself, or maybe next day, we don't know. But then immediately our attention should shift to this lower reference. And what then I was thinking that, okay, we are accepting inside this area where there were buyers who were stronger earlier. That means that these buyers have given up. And now what will happen? These buyers have given up. Should we immediately short it and expect prices to go down? No. Smart money does not work that way. Smart money would never sell lower and buy higher. Trend traders will keep on making that argument that we do have buyers coming again and again after consolidations and taking prices higher. But in those consolidations too, smart money will always try to buy lower. So, and sell higher. Now, in this case, the development is definitely bearish. Now, what we want to see is what are the references on the higher side where the sellers might step in, because it's very unlikely that they'll start selling here itself. So what happens? I take two HVNs. Simple. This HVN, a high volume node. There is a anomaly on the profile here also. There is anomaly here. Again, a high volume node here. So I take all these 2-3 levels and I say, okay, we might test here and fall, try to enter the value and fall immediately, or we might enter the value and then find rejection and come down. So that was how I developed my view for that particular day. Earlier, it was a P and I might have I would have said that, okay, this is a P, we need new business to move higher. So I might be hoping for this because this gap was there. We never came down to test the open and the low on that day. So everything was pointing to, strong performance by the bulls. But then what happened? We just got extension in 2 periods and then nothing. So that again alerted me to a possibility that maybe the bulls are tiring. So you have to combine all these things and try to come out with 2-3 scenarios and then monitor the market, what it is doing, and then take your view. So here I came to a view that, okay, lower prices are getting accepted. Bulls have stopped defending this level at least. So we might test the next lower level. And for that, if I want to short, I need to see some higher references where they might come in. And they came around these level, I believe. I have the next chart. And so I was looking for a short on this day, and I had posted this on the, these are all by the way Slack entries which I have done. I've tried to use whatever I have shared beforehand, not after. So what happened? Prices did go higher. They, now you might say that why this reference was respected and why not the lower one? Why prices did not reverse from this reference? Why go into this and why not into this? Now this we cannot tell, because this whole area had sellers trying to match the buyers. So smart money has entered in this whole region. Now whether we reverse from here or we reverse from here or here itself, we cannot tell. How do we find out? We find out by using first what patterns are forming on the profile, and then we get into order flow charts to get exact levels where we can enter. I just posted a question that day on the Slack to see what pattern was this, and this was the D pattern. This pattern is, I have given it a name D, but what happens is we form a value, try to break out from that value. Given this whole development which was happening earlier, then this particular value forming lower, we already had bearish expectations, and now price is trying to move away from value and going into previous area of supply which was confirmed by this lower value. All these, once you start using it for a while, you'll start getting these points pretty easily, and trades will just jump out from the screen and grab you instead of you looking for them. So what happened, as this spike was happening, I was immediately interested in taking a short, but I needed some confirmation. And where do I get that? As usual, I get it on the order flow chart. Let's look into it. So here we are. This was the spike, and this is a 15-minute order flow chart. If you can see here, it's a 15-minute order flow chart. So this was that value which was forming, which you can observe on this software with this histogram. And in this histogram, they have bifurcated the buyers and the sellers. So you can also see like this dark red means that this is the level where most of the selling was done. Now, as I said, smart money won't sell lower. They'll always sell higher. These are not the smart traders who are selling here. They might turn out to be right at the end of the day, but still their timing is off. And what happens? Immediately the smart money comes and marks the prices up. You can see these trapped buyers, I am saying. Why? Because these sellers, early sellers, had to cover their positions. So their stop loss was hit. You can see many blanks, zeros on the order flow chart. That suggests that there was no trading because their stop losses were getting hit. And what happens? We enter this range which we had marked earlier. We see this kind of development happening. Now it's not necessary that you will get a delta divergence on all time frames. So here we get trapped buyers. That is a sign in itself. And we then monitor smaller time frames to see if we get some more clear signals of delta divergence and all to enter a position. So this is still not an entry. I might enter because I am now using this 15-minute charts. I know what is happening on the lower time frames. So I'm a bit confident, and what I do is I see this kind of development, I immediately sell. But of course, not without context. The context which we generated for the past 2-3 slides, that is there, that is happening continuously during the market hours in my mind, and I keep sharing it on Slack. And once I get it, I might not even check the lower time frame charts to short this market, which I did actually. I took that trade and it was a profitable trade. So this is the 3-minute time frame order flow chart. So what is happening on 3-minute zeros in the, what is happening on the 3-minute chart? I'll just show you what happened. Yeah. This was that spike which happened away from the value. Now on 15 minutes you could see only some zeros. But on this 3-minute chart, you will immediately see that there was no trading happening in this zone. So zeros mean there was no trades happening in this zone. People had put in their stop losses at these levels. As they were elected, immediately buy market orders were sent into the market and there was no trading. And the first order that executed after this level was here. All the shorts that were trapped in this region were forced to cover. And who was taking the other side? If I was short here, my stop loss is getting hit, so I have to buy. Now my buying is supplied by selling, and who was that seller? It was the smart money. Why it was the smart money? Because it was selling at higher levels, right? And against the prevailing market action, which was a spike, and everybody gets excited. Oh, this is a breakout. We might test the high, and those what you call it 80% rules and all, they immediately come into picture. I mean, 80% rule might be there. It might work. It may not work, but it's not required. Basically, to trade, it's not required. So, what happened? The zero suggests that the stop losses were being hit. There was no trading interest. Then we do not immediately short here. Excuse me. Then what happens? This bar did not make a new high. This bar made a new high. And as soon as we made a new high, again you see these high numbers coming right at the top. Now, how do I know this is the top? I cannot tell this is the top before this bar is over, mind you. When the prices was trading here, I was expecting, I don't know whether this is really a breakout and really will go higher and test higher reference. I never knew that. So what I wait for it? You have to wait for it. And at the same time, when this bar is developing, I try to monitor the delta. What is happening with the delta? This was 1,33,000. Here it was only 19,350. Now, as we come closer to the close of this bar, it becomes starts becoming clear and clear that the delta is not going to move up substantially. We already have a divergence. This is a sign of trapped buyers, which is more evident on the 15-minute chart. And as soon as this was done, this divergence was done. This was a 3-minute chart, a lower time frame. We get a confirmation that we might just now get our sell signal. Now somebody interested in further confirmation, you can get even that. Like this is a sign of weakness. We come down on this bar, and on this bar if you check, you have many green prints. This is a narrow range bar. Tried to move higher, closed away from the high. And if you match, try to see the volume, here it was upwards of 1,50,000, here it was 68, here it was 60. So if anybody is aware of VSA, this immediately tells you that this is a no demand bar. So a no demand after a sign of weakness is a confirmed sell with a stop above, maybe this high. So I actually sold earlier because of that experience and watching these patterns over and over. I could sell in this region. Then I saw this no demand. It further increased my confidence, and the prices just went down and gave me whatever scalp targets I am looking for. So this is how I take my trades, using market profile to generate context, using order flow to monitor where buyers and sellers are coming in, aggressive buyers and sellers, whether these are just numbers. At the end of the day, it is your logic that will tell you whether these blue boxes show me strong buyers or these are just aggressive buyers. I have made that distinction in my order flow presentation that strong buyers and aggressive buyers are different animals. Strong buyers we want if you want to continue higher, but aggressive buyers might just be those who are covering their stop losses. They don't have a choice. So there is a difference, and with experience you will start getting that distinction and will help you in your trading. So once this day was done, what happened? Let me show you. This was that spike which I sold into. Prices came down again, kept accepting in this area of prior acceptance. But what we got out of it was that this whole higher balance was now rejected. Okay. So this was my end of the day report sort of a thing, which and these are my potential auction paths which I was expecting. This one starts higher, and these two start lower. So the difference is the open actually. This is where I expect to open. I mean, if this is where the market opens, then I expect this particular price action to happen. But if the market opens lower, then I have again two possibilities: whether I get a failed auction and try to move higher again, or I find acceptance below the low of this day and start moving lower towards this earlier reference, the spike high which we had marked. So this is the kind of a thing that goes on. This is the kind of thing that goes on, and I share my views. I mean, people might say that I have shared two up moves and one down move. At least one of them is bound to hit. But this is not the way take information out of this. What is important is I am expecting this, but depending on the open where it opens, where the next day opens will tell me whether to go for this. Now, as we all know that market opened lower, so immediately this was gone. Then after open we could not re-enter the prior day's range, so this was gone. So what was left was this, and that is how I eliminate these two and then select this one. So let's just move ahead. Many people are asking questions. Let me tell you that I cannot answer them during the presentation, but please do keep asking. I'll try to cover them at the end, or better yet, join the Slack group, post your questions there, and I'll cover them definitely there. So next day, what happened? We opened lower. Now we opened lower. Again, the open is important. We open outside value, inside the range. But what we did after that, we drove out of the range for yesterday. That is a good sign. That is a good sign for sellers. Why? Because, this was prior day's value. We made a lower value. We had this rejection of the upper value. So, I mean, bears were in control, and it was expected that unless and until we reach a reference where we get strong buyers again, this auction is now not going to turn up. So we open lower, immediately we drove down. Again, as I said, I won't jump into this trade unless I'm short here and holding the position overnight. Then I might try to cover here, but I won't buy here also, and I won't try to jump into this sharp move, because then I don't know, if you get poor execution and immediately the price pulls back, you are underwater. That is, your position is making a loss. It's better to wait for a pullback and see how the market is coming back, and whether it is coming back with intent or strength or not. So once this opened, I immediately shared this on Slack, and I said that okay, we might consolidate here a bit and try to move higher. Again, try move higher to find sellers. This high volume area, or the point of control as you call it, was my reference. So I was waiting for that either, or just continuation of the down move. Now, what might alert me to these two possibilities? Again, you have to go into order flow chart. One context which I keep on emphasizing is that this is a spike. We all know that, and we broke below the spike high once. There were some buyers here, those defended, maybe stuck sellers who covered their positions. Once the price returned here, we found some support. But once a spike high is broken, then when the second time price comes in this region, this is not likely to support the price. Let me just restate what I just said. I'm saying that spike top and bottoms will provide support and resistance, but only once. Now, this does not mean that, okay, we broke this spike high and now we are going to move lower. No. If we come down again, then this might not offer you support. But if the price just keeps continuing higher, that is possible. So what we do, we try to monitor if this pullback is strong. If it is not strong, we can immediately sell it, because what we now know is that we have rejected higher value, we have broken spike support once, and if the price now comes there again, it is not going to stop there. It is going to test for lower references. Now, this is how you start building context. Now, just because then a divergence is there on order flow on this B period pullback does not give you that conviction to short the market. But when you combine this context, the picture starts becoming clearer. So let us just move on to the next chart and see what happened. Yeah, that is the order flow chart. It's the same order flow chart for that day. What happened? This is a 15-minute chart. This was the open, and we drove down. We start seeing some sellers here. Again, the next bar is down. Now, this is that pullback. And this is somewhere here was that spike top. We found some support over there. There was the delta was same actually on both these bars, so no divergence. But spike of top offered some support. We started moving higher, and look what happens. This was a good green bar. Volume was decent. On the next bar, what we get is a sharp drop in volume, a delta divergence also. And if you look at this individual bar, you see that this whole blue box has all green prints. That means for this whole bar, buyers were dominating. But still what happens? Prices go higher and again come down and close away from the high. Now, if the buyers were strong, we should have closed something like this near the high. Why we are going away from the high? And we also have this delta divergence. We also have now context that this value was rejected, spike was punctured, spike top was punctured. So there is a possibility of breaking it if we get there. And what we are getting, a nice signal that prices might be slowing to the upside, and now actually we might see some lower prices also. So I could gather from here that okay, higher prices traders are not interested in, so that immediately opens up lower prices. We already have this spike top punctured and we are looking for even lower prices the second time around, and that's why you can enter a short here. There was this yesterday's close and today's open, there was this small gap. You can use it as a stop loss, but it's not very I mean, this is not this is just a reference to put your stop losses. Not you cannot enter your position based on these references. So I get a signal that buyers are not interested. So I take a short here. What happens? Prices break this spike top, go lower, and this time what we see is the opposite activity becoming stronger. Immediately you start seeing these deep red boxes at the lows of the bars. This one, you get a delta divergence. All these activities suggesting that buyers are now not very sellers are now getting exhausted. They are not what you can say that keen to short at these lower prices. Or even if these there were some laggard momentum sellers. See, why I'm saying they are not keen, I'm talking about smart money. Again, what I said, smart money won't sell at lower prices. Where they'll sell at higher prices. At lower prices they buy. So these sellers are laggard sellers, momentum sellers, piling on spike top broken second time. Now you'll see prices rapidly going lower. Even I was expecting, but when you see this particular development, it immediately alerts you that, oh, okay, fine, we were expecting lower prices, but now since so much of selling is not able to push prices down, we are getting a few divergences. It is not what we expected it to be, and we better either cover our shorts, hedge them, but there was no reference lower, mind you, there was no reference lower. So there is this line, but I don't know where it came from. This was not a reference on that day. This might be of later days. So I was not very keen on buying despite this delta divergence, despite this strong signs that sellers are getting exhausted. Because there was not a good reference, I did not buy it. Now what I want to see, okay, we are forming value lower again today. We are seeing that we have broken the spike top, so we are likely to test the spike bottom, and any rally, if it happens, sellers are likely to use it to, enter their shorts again. So we get a spike, and what we observe on this spike, again the same behavior which we observed on the earlier no demand, small no demand bar. We reach the area of that bar, we see a lot of green prints, some heavy buying at the top, not able to push prices even higher. And by the end of the bar, it has closed almost, it has closed negative. It has closed below the prior bar. So what happened? All this buying not able to sustain the prices higher. And we were expecting that since the value was forming lower, we were expecting that if any rally happens, definitely sellers will come in and try to use it to, establish their short positions, which they might have covered here. They might have covered their shorts here. Again, they see higher prices. Again, they'll try to sell. That is exactly what they did. So how did the day turn out? Yeah. What happened? This was that delta divergence which was happening. This is the single print. Okay, I mean, you can use it as a reference. But what I'm interested in is on a volume profile, if you see, there was this small distribution. Here there was one which was tested in the morning. We could not hold that. We broke down. We tried to enter this distribution and we see that buyers are defending, because we saw that delta divergence and all, and we saw this spike. So value was lower. I was looking for a short. Then I would definitely be shorting on this bar somewhere. I cannot short at the exact top, but somewhere here I might like to short to, at least test this low. Also, I keep getting questions regarding poor highs, poor lows, and why you are not using those, because again they won't help you in trading, but they'll get you some context. Now what is that? Here we get a poor low. Now what does this mean? People say that they have a chance of a revisit. Now I have seen poor lows which were never revisited, and for a long enough period of time not to get your stop loss hit. So okay, we get this spike, we were looking for shorts as it is, and in this setting if you short somewhere here and expect to take out the day's low, then that is fine. Add to the fact that this was also a poor low, then you get the stronger context. So what is happening? Here the sellers got exhausted. Sellers get exhausted, we get an inventory adjustment. It's nothing but hitting stop losses of weak sellers who got in late here. They hit their stop losses, accumulate their shorts at higher levels, and again go down. Because the value is down, we are accepting lower prices, so that is bound to happen. Now at this point in time, I was expecting repair of these anomalies on the next day, these ragged edges, maybe test of this and break of this spike bottom and all. I was expecting everything. I saw that the close was near the lows, so anybody who bought in this whole region was already under pressure, because the close was lower and their long positions were underwater. So I was expecting that these anxious buyers would propel the prices lower and break these lower references. I was pretty bearish on that day actually. So I had these lower references marked out already, 8522. I mean, we were closing around 8585. I was expecting some 60-point down move to start with, and even further down move to test lower references. Now this was all my expectations based on lower value, close at the lows. Also on this day the volume increased. Now volume, when it increases, it's a clear sign that some smart money is present in the market. And since the trend was down, higher prices were getting rejected, I was expecting smart money to take prices much lower, test lower references, and looking for a good short. But this is my expectation. This is how I analyze the market. Not necessary that smart money will follow my analysis. So what I start out the day with a few expectations, and then monitor the next day for whether those expectations are being met or not. So I go bearish on this day, and let's see what happened. 1st Feb, the budget day. Now bias. That's what I said, that I went with a negative bias for that particular day, that I was expecting the first to be a bearish, a down day, and hitting lower references. So why? Because the value area placement VAP was lower, uh, close was near the lows, we had increased volume, all pointed towards continuation to the downside. This is where I want to introduce a new concept. I mean, just repeating what we had discussed earlier won't help. So I have introduced this new concept. It's not mine, but I'm just sharing it for the first time. It is the expected behavior. Dalton talks about it. Expected behavior. What is that? I mean, if you are bearish, you are expecting the prices to move down and take out lower references. Now, if the bears are not strong, then what will happen? They won't be able to take out low references. And that is an unexpected behavior. I was hoping for a down move, and if the prices gaps up, immediately I am alerted to an unexpected behavior. Now, I need to have plans for both in my trading. I should be able to handle both expected and unexpected behavior. And that is the way, I mean, you can on most of the times try to be on the right side of the market. So let us just see what happened. Okay. This was that eventful day. I come in with bearish expectations. Market opens somewhere here inside the value. This was a pretty balanced day. Now, one more thing. Now, okay, all my analysis was fine, but when I look at this profile, I see that it was a balanced profile. And balanced profile means what? All sellers were being matched by buyers. So once again, this was another clue. But still, we open inside this profile, this range value. So we immediately, come to an understanding that, okay, nothing has changed from yesterday. Traders are waiting for the budget, so range is going to be limited. But since our expectations were bearish, I was looking for downside continuation, which I got earlier in the morning. We move down and we break yesterday's low. What happens then? Come further down, and this time we test this level, which was the spike bottom. This was supposed to provide support, at least for the first time, and it did. Then what we know that it will provide support only once. If we again come down below that range, then we might see we might not get that support. So as soon as this price has rallied, I saw that we again come back in the range of the morning, high and this point of control, fairest price for that day. I see a possibility that, okay, we have already tested this spike bottom once. There is every chance that same thing might happen which happened with the spike top. So try to short here, you go down, balance in this region. But there was a good observation to be made. Not always these observations are made in real time, but if you see highs, so the lows were, rising. Subsequent time periods were not able to make lower lows. Like we had this C period, E period came back, made a higher low, F higher low, G again a higher low. So this is a sign that demand is slowly becoming stronger. On the volume profile, you will see it as a nice gradient. Gradient as in a slope, nice slope, a very little volume here, and as we move away from value, the volume drops. This is a nice gradient, and it is a sign that interest in lower prices is slowly going down. So expected behavior was to go down, break the spike bottom and continue lower. But I did not get that. What I was getting, near the lows, slowly buyers were entering. And they were actually supporting the market. And my expectations were for down move, and I was getting a development that was contrary to my expectation. And these are the subtle things which you have to do to benefit from this beautiful tool which we all have exposure to now, and nice softwares helping us plot these charts. So what happens, I have just split the profile. Budget is over. There was no surprises in the budget, nothing substantial happening, at least not in the speech. And then why the market went up then? If there was nothing in the budget, why didn't we go down? And the reason is we have seen short interest for last 3 days and even on the early part of this day. Every time the prices went higher, it was being hammered down. So that was the general behavior, short the rallies. But as we see that it's not able to take out important references on the downside, and we are making higher lows, and there is a nice gradient here, and we are expecting lower prices and we are getting a gradient, a contrary development. There was every chance that smart money would come in and put all these shorters under pressure. And what they did exactly the same. These stop losses went first, then this, then this, then this point of control, this high volume node. Everything was taken out in, a few, what you can say, minutes or in an hour or so. Everything which the sellers, accumulated over the last 3-4 days, 3.5 days, everything was taken out in a single blow. And that's my analysis for the time being, that this complete move was a short covering move. Only these shorts were forced to cover. Very unlikely that we have really good new business in it to continue even higher. That was my view. Of course, market will prove us right or wrong in time. But one more thing I'd like to point out is this area. I mean, we come to the highest value which was developed, and then we see some rejection happening, some pullback, but immediately that pullback was bought into. So this whole region tells me that there was this reaccumulation going on in the markets. That is a sign that, okay, some new buyers or maybe momentum buyers are now stepping in. We cannot be sure what quality of the buyer is at this point in time. We can only gauge it by response. But we know one thing for sure, that now since these stop losses are getting hit, the market can go anywhere. So, I mean, this was not a buy signal. People might have bought in this, but I could not. But we had some reaccumulation. So this becomes an important reference zone for me in the coming days. So moving on. So, this is how I track the markets, and this is how I try to, get into positions and trade using my analysis. Yeah. So once again, I'd like to, point something out regarding context, how to generate context. So the key to generating context is your trading strategy. I mean, you're not here to understand the markets only. You're here to trade profitably. So if you want to trade profitably, first and foremost is your trading strategy that needs to be sorted out. Some of the examples are buying breakouts and selling breakdowns. You can fade breakouts and breakdowns. That also is possible. Or you can try to buy low and sell high. I mean, this strategy is used by smart money, that's for sure. So, I mean, let's just revisit the previous example. And I also, I try to do this. How? Maybe let's forget about how I do it. Let's just see how smart money does it. So let's just visit the previous example, to understand this third strategy, how we do it. Buy low, sell high. Now, how are you going to know that the price is high enough to sell or low enough to buy? That distinction you should be able to make. And how do we do it? I shared this example in my last presentation about shopping. I said, if you are shopping for a tie on a day of an important meeting in a new city, you just go to the shop, buy the tie at whatever price you are getting, and just get the hell out of there. Means that in the markets contest, it means that the price got out of whack or out of the current value in the short term, and whatever smart money or stronger players were present in the market immediately push it back into value. So this is one behavior. Next, I gave you an example of shopping in a mall. A big market mall is where, big buying is done. So in the context of the market, what it means is that you need to be aware of smart money buying and selling, or maybe smart money entering the markets as and when they do. You need to be aware of that. You need to keep an eye on that. And lastly, I shared an example of, shopping for a marriage. I mean, it's a very big deal. A lot of money and time is spent on it. And that is how smart money accumulates their position. They won't buy in a buying tail. It's not possible, because there is not enough volume for them to accumulate their position. They will always buy where there is some consolidation is going on. So how that happens? Let's just go back to the previous chart and I'll show you. Same chart I have shared here. See, this is what I mean. That value, next day the value was forming lower, and in the context of this lower value, when the prices went higher, they were immediately sold back. Now this is what I call the first type of buying, shopping for a tie. You are not interested in looking at what varieties of ties are available. You just want to match it with your coat and just get the hell out of here. You are even ready to pay higher prices for that, because you have a meeting to attend that is more important. So this just got out of the way, and immediately smart money, strong money, it immediately pushed it back into value. This is called as shopping for a tie. Again, see an example over here. This was lower value, we were accepting at lower prices. We had tested an important support. There was every likelihood that we might test it again. Prices started to rally so sharply into this previous area of interest point of control. Again, smart money comes in, hammers it down, shopping for a tie. Next we come to shopping at a mall, or maybe window shopping, just trying to get a feel of it. This is what happens. You see prices trending down, and then you see a nice balance profile. What it means? Buyers and sellers are matched. This is a sign that strong players are slowly coming into the market against this prevalent trend. The same balance which formed here against the uptrend, now it is forming against a downtrend. Trend is decided by the placement of value area. Lower value, trend is down. But now a balance profile immediately alerts us that, okay, the opposite party is now entering the market. And this behavior, though we had some lower value developing, but again was continued on this day. The range from this point to this point was lower than from this point to this point in the early part of the day. So this is where you get an idea that smart money is entering, and this is called as shopping for marriage. Volume high, you see already have that evidence that smart money is entering, and here again we get the same behavior repeated. And on an event day where nothing good was being said, nothing exciting was being said, and prices was not going down, it means somebody was buying in this area. So where is the excess, you tell me? There was no big buying tail at the bottom, nothing of that sort. Nothing here also, no gap, nothing, no signs of excess which are generally discussed in market profile context. Nothing was present, and still what you get? This sharp move higher. Why? Because these are the areas where the market spends most of its time, is where smart money enters. Not all areas are used to enter. That distinction we have to make. So put it in context and see that smart money is entering, see further evidence, and then you can take some positions along with them. Or at least if you're short going into this day, that was the sign that, okay, we need to get out of that because smart money is entering. So this is how I use these three types of activities, buying or selling, as you call it, to gauge what smart money is doing and where they might be entering. Okay. I hope you understood this. So let's just revisit the decision-making process which we started discussing. We study the previous day's action in detail to get some context. Then we look at the open, where it is opening, and how you know, look at the open in context of your previous day's studies. Then we monitor early rotations, whether we are getting information or not. Then we look for potential trades using micro profiles or order flow. I mean, it's not necessary to use micro profiles. You can only use order flow. You can combine them. It's up to you. Moving forward. Yes. So this is a micro profile chart which I wanted to, you know, show you. It's a single chart I have selected. I don't want to get into much details today. So see, this is the open. This was 2nd February. Oh, this was 2nd. This is not 3rd. 2nd February. We open, we go down, we again rally back up on the opening 30 minutes. Then for 3 time periods, we do nothing. What this means is that whatever buying that came in here, sellers now were matching it. This might look like a P on the chart, on the 30-minute chart, profile chart. So what happens? Sellers matching here, they get the better of the buyers, and again we go down and test the low for the day. What happens when we test the low? We get some elongation of the profile compared to these profiles. The range was higher, and we test the low. We, you know, close back up above the low, but this is still not a confirmation of a failed auction. What we need to see is what happens on the next period, and next period forms an inside bar, an inside day. So if bears were stronger here, they should have broken the support and got another elongated profile, but nothing of that sort happened. We get an FA, an inside bar, going into this morning low, or IB low as we call it. This was a sign that bears might not just be interested in, you know, taking the prices lower yet, or maybe momentum buyers have stepped in and they are buying again. So we see some higher values now. Again, we try to break out, but if you see, the profiles are not very elongated, they are squat. But that is happening because now these sellers are trying to defend their position. And then what happens? We break out. Now here you see good, nice elongation of the profile. Again, there is some elongation. So this suggests us that, okay, buyers are strong, new players are coming in, and we might see higher prices. But then this happens. I mean, this is how you track the whole day during, you know, its development. Nice elongated profiles, we expect further elongation, but immediately we get a squat profile. Again, similar to this profile, what it means is that other side is coming in. But here what happens, that this first bar's high was not taken out by the next 2 bars. But here see what happens. We get a nice balance after some elongated profiles to the upside, means that sellers are now matching. And then we get this sort of an FA, which we got here. Now you might say, why we did not immediately jump into longs here, and here there is a FA and prices immediately fall down. How we are supposed to enter these trades? Now, you know, you need to have some experience with using micro profiles, and we need to discuss this particular topic in detail. But if you look at it, you might also observe a pattern which we had already discussed. Try to find a D shape in this. Value lower, try to move higher, sold back to the point of control. So, I mean, this is the big pattern developing. These are the small pattern internal to that day. You see prices not able to, you know, elongate. You immediately sense that sellers are now coming in, and you see a failed auction in E period. Then if you look at the order flow charts and all, you will definitely see some divergences here, some trap buyers, and you can take a call to sell the market. Now, this was an intraday trade. I was just hoping to test this fairest price for the day. This was the POC for the day around this level. I was just hoping to test that. So it was a nice short scalp here. This was a good trade. If you could have entered here, looking that there was no interest in going below the morning low, immediately you get a feel that this high might be tested. And if you find acceptance above this, then we might go even higher. So that is what happened. I mean, there are not much references used here, but if you use references from your higher profile charts, then it becomes even better. and combine it with order flow, and you have a winner on your hands. So this is about micro profiles. I'm sorry, it's very brief. I wanted to keep it that way. Maybe next series we do it on micro profiles only. Who knows? So let us just revisit objectives for today's presentation. Have we met them? Understand the importance of integration. I told you what benefit it gives us, and we also saw some examples where we combined these tools and we got some good entries and exits. See what different tools contribute to the trading. Now, traditional technical analysis, I encourage those who are using, please come into my Slack group, join it and share your experiences. Let's see how traditional technical analysis and market profiles work with each other. Then we saw many examples combining market profile and order flow to get a better grip and to find better entries. And I briefly introduced you to the micro profiles, which is a great tool if you are focusing on intraday trading only. So that was the fourth part. I hope I did justice in this 4-part series. And I hope I have been able to, add something to your understanding of the market. We hope there was a nice response we received to this first attempt, and we hope to continue doing this in coming days. Now, those who want to access our Slack group, please copy this link. And fill up the feedback form. If you have done it already, no need to do that again. You already have received the Slack invitation. If not, then please drop in a mail at or maybe just refill the form and you'll get an invitation. And the recordings for these presentations are being made available on the Bell TPO website. You can visit the website and you get that recording. If you are into the Slack group, I'll share the link with you. Yes, definitely we are sharing that. Join the Slack group and you'll get every details there. Vinod is there. Vinod, if you are there, I think I'm done with the presentation. Let me check the time. Okay, it's just over 1 hour. Sorry, what happened? I think I'll take a few questions. I'll just check in the chat what questions were there. Okay, maybe you can just type it once again. Everybody who have some question, please try to type in. No, I'm not addressing on the chat. I don't know how to identify. No demand is a VSA concept, Amit. No demand is a VSA concept. This presentation is not intended to cover VSA concepts. So maybe in the Slack group, I'll show you some examples, but anything else? Zero refers no trades. No trades because there were no orders at that level. Usually happens when you have a spike or a stop hunt, as we call it. So that happens when we have that stop hunt, where suddenly a lot of orders enter the market. They are entered at market, and that's why they end up executing at levels where there is opposing orders matching. Till then it will just go on moving. Yeah, I have been following Ilanbo sir, but long back, not very converse with his method of trading. No demand in OFA. Again, I'll say that no demand, you need just price and volume. Order flow, order flow does not have anything where you can understand it is a no demand. Acceptance and rejection, I can show you. I'll just go to 30. Where is that? Short trade on 30th. This one you are saying? Who was it? Ashish? Is this the trade you want to? Yes, okay. So again, I'll try to tell you that we had this context going. uh, we had nice value developing. Next day we open lower and form value at lower level. Value traveling lower means that bears are in control. The trend may have shifted to the downside. In which time frame we are not yet sure, but for the day at least any rallies will be sold into, and that is what happened. We move higher. Now we try to identify a couple of references higher. These higher volume nodes were one of them. This point of control was one of them. And what happens, we just move into this resistance and sellers show up. How do we know sellers are there? We look at the order flow chart. We see one indicator which we use regularly is trapped buyers. Heavy buying prints at the top, prices not able to continue higher. Then we see divergence, and divergence tells us that that sellers are now slowly overpowering the buyers, and the trend might change. So acceptance and rejection is again, if you look on any profile chart, nice value forming, thick area forming is acceptance. Rejection is where this is an example of rejection. The price was not traded through. Gap is an extreme form of rejection. This spike is a rejection. This is a rejection. This is an acceptance. Share the Slack chat link. Yeah, just give me a minute. Does order flow show if there are any algo entered? Now, algo are there all the time, I guess. I am not sure how to spot an algo, but that does not affect my trading also. Yeah, you have to make that distinction, and not every high number is a sign in order flow. And that is where, Thirumal, that is where you need to have that context. Unless and until you get the context right, order flow is bound to mislead you. I mean, spotting algos or buyers or sellers, everything is fine, but unless and until you are at a good reference and you have some context backing it, your orders, order flow will just flummox you. That's all. Yes. Any more questions? That link I have to share. Yeah, I'll share it in a minute. Where is that link? Yeah, here it is. Copy and yeah, here is the link. Oh, where did it go? Oh yeah, here is the link. Enter. Please go on this link and please fill in the form, and we'll get the details, and we will send you the invite for the Slack group. Please do that. If time permits, Rahul says, if can you please share how you identify OTF and DTF activity? Yeah, why not? In short, we can do that. Yeah. So, I mean, yeah, OTF and DTF, day time frame trades, according to Dalton, are those who do not carry their positions overnight and they have to exit their positions on the same day. Other time frame traders, according to his distinction, are those who might carry their positions for a longer duration of time. And since they are ready to carry their positions for longer duration of time, they need to have some holding power if the market goes against them. And that is what happens in case of higher time frame traders or stronger traders, something like that. But see, here this particular tail might be used by people as OTF indication. Okay, this gap is an OTF indication. These single prints are used by some as OTF indication. Okay, DTF is this value. Whenever there is a thick value, it is used as an indication of DTF. So here there is a DTF. This early morning tail was OTF. This sharp rejection was OTF. This spike breakout again is OTF. So this is how OTF and DTF are spotted on market profile charts. But what I use is the distinction between smart money and not so smart money. So even though we have tails here, this was an attempt to break out. So you might say this was OTF moving away from value, but it was sold into, because this was not so smart money trying to take prices away from value against the trend. So I try to concentrate on whether we have smart and not so smart money playing in the market, rather than blindly just going by, oh, there is a tail and the OTF is there. It's not like that. Many times tails are traded through like breeze. Sometimes poor lows hold for months. So I mean, that's that's how I look at market profile. But these are the common signals: single prints, buying tails, gaps. These are the signs of OTFs, and thick value is generally a sign of DTF. I hope I have answered some part of your question, maybe not in that detail. Any more questions? If not, then I will transfer this session to the next presenter.